Slides for today's meeting. Welcome, everybody. Looks like we have quite a few guys on right now. So let me get started here. This is our usual disclaimer that we put up for just about every SIG meeting we have. Take everything you hear here with a grain of salt and check with your personal advisor and, do your due diligence as usual. I go through these slides every time, so I think everybody's seen these before. So I'll just mention them again that we're here primarily for income only. We're not here for capital gain so much. That's kind of a second choice for us. And of course, most of us are either approaching retirement or within retirement. So we're kind of aiming at that demographic, so to speak. And then I'll put in a plug for the Google Groups site that we have. It's there for you to use as you see fit. I'm glad to see that some of you guys are posting stuff there. By all means, it's there for everybody to share ideas and bounce ideas off of everybody and get some feedback. This is the latest version of the Portland website where the webinars are listed. I've updated it the other day, and you can see that there are all the mainstream stuff that we have. The main chapter meetings are listed there as well as the income SIG stuff. So by all means, please use this for linking to the various sites. It's a great way to go back and look at stuff that might be of interest to you. Todd, do you want to chime in here and bring us up to date on what's going on? Tell us a little bit about the November meeting. And by the way, I really liked yesterday's meeting. That was a good one.
Oh, good. Yeah, thank you. For those of you who were able to attend, I think we had an enjoyable meeting, and it was very informative, and I thought there was a lot of good analytics in the presentation. And if you didn't get the chance to view it, I believe that we're going to have this recording of this posted on the website sometime in the near future, probably later this week. So I would encourage you to check it out. And that was Timothy Bach from Summit Investment Advisors talking about their approach to investing that used a lot of index type of funds, but weights differently. And as usual, we had some very good questions on the call, and I appreciate that. And now we do have another meeting coming up that's going to be on February. Let me get my months right. November 20th. And our speaker for that meeting is going to be Jack Bowers, who specializes in investment sectors in the equity market, and also with particular expertise in the Fidelity funds. So those of you who own some Fidelity funds or have an account on the Fidelity platform, this may be a particular interest to you, and he's going to talk about. But whether you own Fidelity funds or not, you may own sector funds. You may be thinking, what are the best sectors to own? He's really going to emphasize that. And that's going to be Saturday as this meeting. And that'll be, again, Saturday, November 20th with a 9 a.m. starting time. So you'll get some communication on that in the next week or two max. And so we're looking out for that. And you might want to sketch that in on your calendars. You're aware of that. So this meeting will be webinar only. We're still webinar only for the foreseeable future. And we're going to continue in that format. So we're all used to the Zoom and GoToMeeting formats by now, I'm sure. So we encourage you to sign up for that meeting and come in. And I mentioned that we always get some good questions. I want to personally point out, I think Homer Chin's on this call today. Homer, thank you for the excellent questions you submitted yesterday. Appreciated that. And I'll turn it back to you, Andy.
Okay, thanks, Todd. Any more questions for Todd before we move on here at all about the upcoming meeting? Yeah, I'll, send me a note, something, Todd, and I'll send it out to our guys, to our group, because
Right.
I wanted to go back and look at some of the things he said about book value that he was talking about yesterday. I thought that was kind of interesting. I wanted to compare that to how some of the income stocks do if you do use that parameter. So
Well, yeah, and when he discussed his valuation metrics, particularly using goodwill, I think that's interesting as well, because a lot of times, you don't hear that much about goodwill, but when companies are paying up for assets and they've got that, that goodwill, of course, is the difference between, the actual market value of the underlying assets and what they pay for them. And that tells you sometimes that some companies may be have excessive valuations on their balance sheet that they may have to write down at some point. And when he went into that, I thought that was very interesting.
Yep.
And, and that I don't want to go too far afield, but also that, one of the questions on the call was, well, gosh, book value, and now we have so many companies with intangible assets that are tougher to value, don't really fit into the book value category. So it makes it interesting, particularly in the technology field. But I don't want to redo too much of yesterday's meeting, but it was interesting, and I think it's well worth going back. I'm planning actually going back and reviewing it myself to make sure I got all the pertinent points that he made. So.
Oh yeah, I think that, yeah. Okay, thanks.
Yep, thanks.
Okay, so here's our meeting agenda today. By the way, if you want to chime in at any particular point, just click on your mic icon and comment on it. We're going to have a kind of an open forum discussion here, so by all means, don't hesitate to chime in. But if there's a lot of barking dogs or wives in the background yelling and screaming, mute your mic so we don't have too much of that background noise and so forth. So, and then by the way, I have found sometimes that if you turn off your video, it sometimes enhances the quality of your session, but that's purely up to you and your internet service provider. So, okay, what I was thinking of doing today was we have a kind of a general discussion about some dividend stocks. And then about 3 o'clock or so, we'll wrap that up. And I needed to open up a discussion on the meeting format that we're using, because there's some things changing at headquarters that could possibly affect us either indirectly or directly. I'm not sure. So, I just want to get some feedback from everybody, and we'll kind of wrap that up around 3:30 or so. And then our next meeting will be on December the 7th, assuming that that I can find somebody to talk, or we'll continue with discussions on dividend stocks. Okay. So at this particular point in time, I'm going to turn it over. David, did you want to start with IBM or with some other stock or something? Do you have something that you want to cover here? While I'm doing that, I'll stop.
Sure. I don't have any favorites, but I have two on my watch list that I'd be interested in hearing comments about. One is IBM and their recent announcement in the DI articles about their split coming up and how it might affect dividends. And the other is AT&T, which has been on my watch list for some time. And I just double checked and noticed that while I had been slightly in the positive on the capital appreciation side, I'm now 10% negative. So I think their price is already being impacted.
For everybody's information, can you bring us up to date on what's going on with IBM? Is that they're going to split into two companies, right? Is that the way I understand it?
Yes, they're splitting off. I think the hardware piece is staying intact as IBM, and their other services are being split into another company. And I believe that the article said that was going to happen yet this year, this calendar year.
I brought up the fast graphs here just to have something to reference to talk about it. And I'll explain a little bit about it because it's sometimes a little difficult to understand what this chart shows you. Let me take off the price and the dividends here. And the shaded green area.
Andy, we don't see the fast graphs charts.
Oh, you don't?
We're not sharing it.
All right, let me start sharing then. I'll stop sharing and then I'll share again. See what I can do. Can you see it now?
Yes.
Okay. So this is I use fast graphs and it's a fundamental analysis software package. And I like it because I can quickly go through my stocks and look at how they're doing and get some quick picture of what's going on. I mean, there's other ones around, other software packages that are just as good, I think, but this one happens to be the one I happen to use. And so the dark green area, shaded area here, is the earnings for the company, for IBM. And as you can see, for example, and then the orange, that little orange line that goes along here is what's called the 15 times earnings line for that particular company. And they use the orange line as kind of a, what's the right word, a reference for what a company of this type would normally, in a normal market, normal conditions, go for 15 times earnings. And then the blue line is the actual market valuation on the stock. In other words, the price earnings ratio. For example, you can see here, the blue line shows a nominal PE of 14.02, which is slightly below the 15 times earnings. And then what you can do with this particular, if you put the price on there, hopefully I can do the price. You can see that the price kind of follows the earnings, but it wanders from it from time to time. And in the particularly in the IBM case, you can see that the price is undervalued with respect to the earnings for IBM for many years. It's 1, 2, 3, 4, 5, 6, 7. For 8 years or so, this company did not perform at even 15 times earnings. And but you can see back here that in this period here before the 2000 .com recession, that it was earning well above 15 times earnings, or much stronger performance. So one could argue that this stock is undervalued, and and being the foolish guy that I am, I bought some here at actually, what did I buy? At $138 a share. And you can see it marked on my particular chart here. And my hope is that if these analysts are correct, then then this stock should appreciate quite a bit. And at the same time, I can get some dividends off of it. So let me put the dividends on here if I can. Oops, that's not what I want. The white line is the dividends for this particular company. So as an income investor, I'm I like this thing because it's paying a 4.5% dividend. But now, if they split this company apart, I think they want if I remember right, the Red Hat portion, which is the cloud portion of the business, looks like it's doing pretty well. And then their tried and true other side of their business is more conservative and probably not earning anywhere near the gross margins that that the Red Hat side is doing. So, and I think that's why they want to spin it out. I don't know. Anyway, anybody have any other feelings or comments on this thing before we looked at something else?
Well, for what it's worth, Andy, the Simply Safe Dividends shows IBM as reasonably priced.
What is their safety number on that one? Is it, you know what it is, David?
I can tell you in just a second here. IBM. 65.
65.
Yeah.
That's kind of on the low side, isn't it?
Yeah, it's still in the safe, what they consider the safe range. But it is lower than some that like Cisco, which maintains in the 90s.
What about you know, AAII dividend newsletter? What, I think they have that on their list, don't they? Let me look at that. I don't think I have my. Let's see. I have the AAI newsletter here somewhere.
I don't think they're on the DI.
It's not on the AAI, IBM. Oh, excuse me, the IBM is not on the.
I don't think it is on the DI.
Oh,
I
okay.
don't know for sure offhand.
Anybody know? But anybody have the AAI newsletter?
I can get it real quick.
Oh, okay. See it here in my stuff. Oh, here it is. Okay. I have November's newsletter right here.
Oh, okay.
Yeah, it's listed in here. Yeah.
Oh, it is. Okay.
Yeah. I don't know what there was something that they posted on Friday, I think, on this one.
Yes.
Did they
Yes,
have an opinion on it, or did they just alert everyone?
I don't remember. That's the one that I forwarded on to everybody, or I tried to.
Uh-huh.
And I don't recall there being an opinion on it. It was just kind of factual, just an update.
Okay. Any other comments on IBM before we open it up for another stock or something?
This is Tom. I'll toss in a kind of my perspective, and rather than kind of looking to the future, I'm very much looking in the past. And I look at the dividend, and the stuff I'm looking at is an analysis I did probably 30 days ago. So it's a little bit different than what's on your graph, Andy, but it's still pretty much the same. But from my standpoint, I look at the yield, and 4.74% yield is good. So I like that. The 5-year dividend growth is 5.4%, which is okay. What's disappointing is their total 3-year return, which is kind of shown in your graph of 2.7%, and their 5-year return of 1%. So although I own it, it's kind of on my list because I think they're better choices that would give me the same return, the same growth, and a better total return over 3 or more years.
Yeah, that's my I'm kind of of the school that anything over 3% in terms of the dividend, and if the dividend's growing at say 5 or 6%, I'm kind of I'll live with it, so to speak. But yeah, I kind of agree with you. Yeah, I have mixed emotions about this one, to be perfectly honest. Yeah,
it's the total return over 3, 5, and 10 years that really is disappointing, and they're better choices. Not that IBM is particularly bad because it's got a nice yield and okay growth, but it's just that total return. I can pick something that's got a better return. Anyway, that's my quick assessment.
Well, this I just switched over to another page on IBM here. And this for the left-hand column here shows you the dividends per share and the dividend growth for the period of time. I think it's around 20 years. And you can see, for example, down here, what Tom was pointing out, the dividend growth rate for the last 2 or 3 years has been very low, 3.5%, 1.2% down here for 2020. But if you look at it over the fairly long period of time, you look at the dividends from the S&P 500 over on the right side here, it's still done much better than if you had held the, an ETF for the S&P 500. But the fact that it's slowed down, that's an issue. That's a concern. And then if you go down here in terms of the capital gains, you can see that you would have done much better off with the S&P 500 than you would have done with IBM during that period of time.
So,
Yeah.
Andy, can you make that page show like 3 years or 5 years rather than 20 years?
I can, yeah.
Right at the top.
Yeah, 3 years. Let's go 3 years here. Well, let's do 4. Let's see what that does. Waiting here.
Just because I'm very much, what have you done for me lately?
Yeah. Well, there's 3 years right there. Well, actually, it's only 2, isn't it? 2 past years. Let's go 1 more and see if that gives you 1 more year, 3 years. What was there something here that you wanted to note?
Well, it really highlights the difference between, if you look at a 20-year standpoint, it looks really strong. If you look at
dividend wise, you mean?
Everything, dividend wise, growth against the S&P. You could see annualized return on something, but 8.7 versus 16 for the S&P. So it's just not keeping up.
Yeah, that's right. If you look down here, here's the S&P, 16.8% for this period of time, and here's IBM, 13%. Not so good. Not so good. Yeah, I guess you can make an argument for selling this thing. Yeah. Let's see.
The dividend payout ratio is also high.
Is it pretty high? But let's go here and go back to all. And if you go down to, let's say here, the payout ratio is 75 point. Yeah, that's pretty high, isn't it? Let's see. Let's look at the cash flow and see if let's go to cash flow, free cash flow here, or operating cash flow, and see what this thing shows us. Well, it's not bad. I mean, that's, from operating cash flow, I mean, here's their earnings right here, and here's what they're doing. Payout ratio there is 38%. That's not bad. Let's do free cash flow and see if that would be even better. Waiting here. Yeah, they don't have any data here, so looks like it's all, they don't have any future data. Yeah, here it's 37%, so pretty much like the operating cash flow as well. Any other comments before we pick another stock to go look at?
The only reason that you might want to hold it is if you're anticipating that there is a turnaround in IBM and with an increased returns in the future. The dividend yield is about 7.58.
Yeah,
The, what should I say, yield, earnings yield is 7.23% that you show over there.
yes. Yeah, what he's pointing out is that, by the way, this is something that I think is important to understand about dividend paying stocks. If you take the price to earnings ratio and you invert it, it gives you what's called the earnings yield. And the rough rule of thumb is you should never buy a dividend paying stock unless it's priced to it's a dividend, its adjusted earnings yield is 6.5% or higher. And so that, by the way, that was one of the reasons why I took a position in this thing, because as you can see here, it's at 7.23. And, if you look at the analysts here, there's a lot of analysts covering this thing. There's 21 analysts here that are covering this particular stock, but they're off by 53%, at least the last year's estimate. And their track record back here isn't so hot either. Let's look at the summary. Well, I don't know. I guess it's okay, but not spectacular. Yeah, so the analyst community, I guess, has done a fairly good job on this one. I don't know.
Andy, would you tell me again what that 6.5 parameter is?
Oh, let me go back to that. If you go over here, you see your earnings, your earnings, the price to earnings ratio. If you invert that, in other words, if you, for example, let's take the price to earnings ratio for the stock right here, and you can see that it's a PE of 13.84. You see that?
Yeah.
Okay. If you invert that, that is the earnings yield. That's the amount that the company earns. Think of it this way. If you own this business completely outright, and you were investing in this particular business, you would have an earnings yield of about 7.23%. In other words, why would anybody any rational investor buy a company that was paying anything less than, say, 6.5%? Because that's kind of what the going market is for the S&P 500. So, but now today, in today's market, the S&P 500 is so much higher. It's way overvalued. But on an average, you want to get 6.5%. I don't know, John, is that?
Yeah, that makes sense. And what do you call it? You just call it the
earnings. It's called the earnings yield.
Okay, yeah.
It's just the inversion. It's just the inversion of the price to
Right.
earnings ratio. Yeah.
Right, okay.
And
In fact, by the way, it's a good way to to screen stocks if you're looking for dividend paying stocks, for example. What you do is you go into your screener and you set it for 6.5% earnings yield, and then maybe you pick stocks that are aristocrats or something like that, and then you do a sort on that. It'll bring up any company that happens to be, with those two criteria. And so that's a good place to start. Another way to do it is to use the CCC list, that is commonly used. What they call contenders, champions, and
Yeah.
and you can sort on that based on and then of course you'd want to sort by other things too as well, like credit ratings, and maybe you use SSD, for example, and do a sort based on that to look at a particular stock to see how good their credit rating is.
Andy,
Yeah.
you might want to evaluate the S&P 500 also, so that you get a understanding of what the valuation of the S&P 500 versus IBM.
I can do that. Let's see if I can remember how to do it. I think it's SPY. No, that's not going to work.
I think it's just SPY.
Well, no, on fast graphs, there's an up caret that you have to put in. Let me see if I can find it. I can look at
S&P 500.
yeah, let me just go down here and SPX, there it is. I think that's it right there. And oops, SPX, okay, let me SPX, okay.
I just need to clear that, I think.
Yeah, okay, let me just hold on here. Ah, there it goes. It's working. Okay. All right. So this shows you the S&P 500 and the earnings history for the last 20 years. And again, the orange line is common on nominal price to earnings ratio of 15. And then the blue line is the nominal price to earnings ratio. That's the price to earnings ratio that the market recognizes for the S&P 500. And as you can see, the price of the stock, which is the black line, is way above. The price earnings ratio currently is 23.86%, or not percent, but 23.86, compared to, let's say, the nominal price, which would be about 17, or if you wanted to go to a industrial average of that particular family of companies, it would be around 15. So one could argue that the S&P 500 is grossly overvalued at this particular point in time. Now, here's the blue on the white line, of course, is the dividend yield for that. So, and I think most analysts would agree that, the S&P 500 is way overvalued, and we're due for a correction. And you can see that for years, it has underperformed and overperformed, and we're in a period right now where it is overvalued. There's no question about it. So, and you can see that the earnings yield, for example, is only 4.19. So, all these people who buy these ETFs that are S&P 500 are getting a earnings yield of something like 4%. Well, they could do better in a corporate bond, for crying out loud. So why take the risk of buying a ETF at this particular point in time, when you could buy a corporate bond that pays about that much anyhow. So in general, ETFs are, Standard & Poor's SPX is grossly overvalued. Yeah. Have we beat this one, this stock to death? Shall we move on to another one? What do you guys think?
Okay by me.
All right, let's who else has another stock they want to take a look at? Don't be bashful.
This is Homer. I've got one.
Okay.
It may be a little controversial, but it's Annaly, NLY.
NLY?
Yeah, it's a mortgage REIT.
Okay, mortgage REIT. Oh, yeah. Okay, there we go. Let's do that one. Oh, this should be fun. Okay, so Homer, do you want to talk a little bit about this before you?
Yeah, I'm no expert, but this is it's a mortgage-backed REIT that is paying 9%, over 9% interest. So in this on your graph, it says dividend yield 10.35%.
Yeah.
And the question is, why is it selling at what seems to be a pretty big discount? And I'd be interested to hear what other people have to say. It seems to have been paying that for quite a while. And I wonder what people are worried about.
Interesting.
Homer, this is Ron Jones.
Mhm.
I own quite a bit of it and have had it for many years. And I think what the problem at the moment is people are worried about the rising interest rates, the differential where they borrow and buy is going to go away. I am contemplating, since the dividend just got paid at the end of September, I am contemplating getting rid of at least part of mine.
Oh, because of increasing interest rate or the narrowing between the short and the long term?
Yes, it's the narrowing. In other words, the company is solid. It's not a real problem, other than things are changing for their ability to make money.
Hmm. So they're borrowing short term and they're lending out long term and they're making money on the difference, is that?
Yeah.
And as that narrows, they'll be making less money. On the other hand, the earnings yield here, their earnings yield is 13%. So it sounds like they still have a bit of a cushion.
Well,
Yeah, again, I think they're solid as a company. It's just the issue of where's this going to go, because they buy mostly governmental backed securities, mortgages. And so the question is arising of, where are they going to go in the future?
well, this is a REIT, isn't it, Homer?
It is.
Yeah.
It is a REIT.
Yeah. So REITs have to pay out what, 95, 90, Ron, help me with this, 95% or 90% of their.
I think it's 90, but yeah, somewhere in that range.
Okay. So that doesn't leave them a whole lot of cash to reinvest and grow their business, right? And that's probably why this thing is fairly flat. Looking at the forecast years out here, am I reading that right?
I think it's just the margin between the two rates, more than anything else.
Yeah, but their PE is around 8.76. That's that blue line. So from a let's go here and go here and click that, hopefully. Yeah, so the ROR is 13.7%. No, that's not bad. I mean, that's still pretty good. I don't know. That's nothing to sneeze at.
But I think what Ron is saying is that the longer term outlook is, as interest rates go up, that this might start to go down. Is that what you're saying, Ron?
Yeah, it's the uncertainty more than the absolute, I believe. That's my opinion. I think both Morningstar and Value Line continue to like it, but they're not touting it.
Mm-hmm.
Yeah, it is very tempting, Homer.
Yeah. Well, it's 10% dividends,
Yeah, that's very
if you hold it for 10 years, you'll get all your money back.
right.
Interestingly, SSD rates them at 40, which is risky. I hold a really, really small position, which I'm just treating as mad money. But I'm also underwater on it about 8%. So. Like Homer says, if I were to hold it 10 years, I'd have my money back anyway. So
You're underwater, counting the dividends, including the dividends.
Well, I'm underwater on capital gain basis. I'm not really underwater because I haven't sold it, but in terms of valuation, I am.
Okay, but in the meantime, you've been getting the 10% dividends.
Yes.
Well, that's nothing to sneeze at. I mean, that's pretty good. Yeah.
And it's a really small percentage of my portfolio.
Mm-hmm.
So.
Now, Homer, what kind of mortgages are these? Are these residential or commercial? Do you know?
I think they're mainly residential, but they are government backed, so it's like they're secure.
Oh, Jenny, they're like a Jenny Maid in that sense.
Right, exactly. Yes.
Ah, okay. Huh, okay. I
So
used to
just-
own the Jenny May ETF for a while, but it was nowhere near this. It was 3.5% or something like that. So,
Right.
yeah.
It seems sort of anomalous that it's paying that high of a rate.
Yeah. By the way,
It's been paying
the
that for a long time.
Ron, correct me if I'm wrong, but this yield would be since it's a REIT, it's taxed as ordinary income, isn't it?
Right.
Yeah, I hold mine in my Roth, so I don't worry about it.
Oh, okay, okay. That's a good idea. Any other comments on this one? It's a good one, Hummer.
I was just going to chime in. I own some as well, and obviously drawn by the over 10% yield. But it's interesting. Its dividend growth has been dismal over the last any period. Last year it was down 13%. Last 3 years on average down almost 9%. But it's when you're paying 10% and it plummets 10% to paying 9%, I'm not overly upset. And then in terms of total return, it's actually better than IBM. If you, ignore the last 12 months, that's ridiculously good at 28%. But if you look 3 years, it's up 2.5%. If you look 5 years on average, it's up 4.8%. So again, it significantly lags, the S&P in terms of total return, but that 10% yield is sure nice to see coming in on a regular basis.
Yeah, I was just looking here at the. Let's see if we went back, we shortened it down, let's say to 5 years here and see what we get. I was looking at the yield on cost. Yeah, pretty nice. 12% growth, 13% growth in the dividend. That's much better than the S&P. And well, growth-wise, from a price point of view, you would have been better with the S&P, but overall, with the dividend and the growth, you get about $10,000 investment would give you about 11,000 over 2019 and 2020. I don't know, maybe even more.
Another company that's very similar. Well, it's a totally different business and totally different company, but in my mental categorization is Ares Capital, ARCC. It pays a very, very high dividend of almost 8%, but it shows better dividend growth and much better total returns.
Shall we go to ARCC, you say, or?
Yeah.
Okay.
Take a peek. I mean, it's kind of like NLY in my mind. It's very high yield.
Okay. What's the ticker symbol for that one?
ARCC.
Okay, there it is. Okay. Well, let's go there. See what's going on there. You guys are coming up with some good stuff here. Let's see.
Well, I wouldn't suggest anyone put huge amounts into, NLY or this one, but these both have very nice yields.
Well, the earnings look pretty steady here. Looks like on this one. Let's see, BBB minus. That's just what is that? That's just barely above investment grade, isn't it? Yeah, I guess. It looks to wow. This thing really closely follows the price to earnings ratio for the nominal price to earnings ratio, which is around 10. It's slightly above it right now. The dividend yield seems to be fairly flat. Am I reading that right? Is that, yeah, looks like it's fairly flat. Not very much, but still 7.8% yield. That's pretty good. And an earnings yield of 8.7%. Yeah, that's pretty good. So you have, Tom, are you pretty happy with this one, or?
I've held it for a long time, and yes. Again, I hold it mostly for the yield, but I've held it long enough that the capital appreciation has been there as well. And it tends to be, well, as you can see in your graph, a little more stable than NLY.
Mm-hmm. Well, it's had some very good price. You could, if you picked it up down here, let's say, or say, looks like this was the COVID drop right here. I mean, good God, you'd have done very well with that. I mean, that then goes out to, let's say here. Yeah, 25%. That's pretty darn good. Wow. That's pretty impressive. Yeah, interesting. Any other
Yeah,
comments on this one before we move on?
No.
Okay, let's
if you want another one, try USA.
USA.
Oh, that is my
USA.
that is absolutely my favorite. I'm just so frightened of it, but I love it so much.
Well, you can't buy it now because it's at like a 10% premium.
Really? Hold on here, USA. Oh my God. Wait a minute. What is it? This is not a stock. This must be some sort of.
It's closed
The
end.
closed end.
Oh,
Closed end.
okay. That's probably, we don't have any charts on it. Okay.
Okay.
You like
It's,
this one, Ron? Or
Oh yeah, I've had this one for quite a while. It's gone crazy on me, and I mean in a good way. And I'm very pleased. In fact, if you look at Value Line highest paying that they carry, this is number 2 and Analyze number 1.
wow.
Yeah, there's there's another one that's similar to it, but it sells at a huge discount, and that is another closed-end fund. It's called CET.
Okay. The thing about All-Star that I think is interesting is, in simple terms, they're making the money off the Dow
Oh, wow.
with leverage. I mean, if you look at what they hold, it's not garbage. In fact, there it is over at the right. Oh no, those are related stocks, but it's they're heavily into the Dow, and my yield is better than the 8% based on what I paid for it.
So they own Dow stocks. Is that what you're saying, Ron? Or
Yep. They own pretty high class stocks and are making the money, I guess, off of leverage because they're cranking it out. And
Yeah, will Fast Graph show what they hold? It's pretty.
I don't think it does. I don't know. Does maybe SSD do? Maybe by chance? Do you know have any? Can you look that one up there? You guys.
SSD doesn't. Morningstar will.
yeah, they just put out their annual report about 2 weeks ago. I think I got it from Schwab. So.
Yeah, I have it listed here. Well, the number 1 holding is PayPal. And then it's got things like Amazon, Facebook, Adobe, Alphabet, Visa, Microsoft, United Health, Salesforce, Daimler Corporation. So
those are not frightening companies.
no,
most
they're
of
not. But the it used to sell at a discount of 10%, and over the last year, it's gone up to a premium of 10%. I think that's why you're making some of that money, Ron, is just that the discount has gone to a premium of 10%. That's a 20% swing right there.
Oh yeah. I'm quite pleased.
And that's separate from the market.
Yep. And it's
Yeah, that's interesting. I'm gonna have to make a note of that. Huh.
I mean, I can show you what it looks like on CEF Connect, which is the closed-end fund.
Okay, do you want to, I'll stop sharing and you can, Pick
Okay,
it
let
up
me
or-
share my screen and
okay, I'll unshare and
I'll share
ahead.
mine. And let's see what's happening here. Share and here it is. So this is USA. So this black line is the price of the closed-end fund, and this blue line is the net asset value. So you can see it went from below the net asset value to above the net asset value. So that's where a lot of the money is being made, is just that people are paying more for it than the underlying shares. And so here's the discount, what's minus 10%, and now it's up to plus 10%. So that's a 20% difference just on the difference in the discount.
So Homer, when did you pick up this one? Did you pick it up when it was
No, I actually don't have it. I've been watching it, but I don't have it. But this is the annualized total return. So over 10 years, it's been at 17%, 5 years, 22%, 20%. The last 1 year, it's gone up, what is that, 58%. So it's been doing really well. The one that I have is one called CET, which is another closed-end fund. And this one persistently has sold at a discount. So this is another one of these odd ones where it's doing very well, and yet the discount is minus 16%, which to me, I don't quite understand.
is it leveraged, Homer, or?
Let's see, this one will tell you the amount of leverage. It's got 0.3% leverage, so it is not leveraged. And so this is the discount. So unlike USA, which went from a minus 10 to a plus 10, this has stayed consistently at around 15 to 20% discount. But over the years, it has done pretty well. So the 10-year return is 15%, 5-year 20%. 1 year, 53%. So in this regard, it looks very similar to USA, but somehow it continues to sell at a huge discount.
Mhm.
So, there are these anomalies that are difficult to explain. But this one I have quite a big amount of.
Homer, you might want to explain a little bit about CEF Connect, because some of our members may not be familiar with that particular site. Yeah.
Yeah, the CEF Connect tells you mainly about closed-end funds. It's got a whole bunch of closed-end funds here, and you can do research on all the closed-end funds, and you can sort them. And
That's a free service, isn't it?
Yes,
Okay. Our screen is frozen. Oh,
What's the yield on that on CET?
Homer, are you there? It looks like your screen is frozen. I think he's
yeah, I think he's locked.
It's
Yeah.
about 4%.
4%.
Yeah, Simply Safe dividend says 3.95 here.
So now that's not qualified dividend. That's ordinary income, right?
Yeah,
Okay. So you'd best put this in a tax deferred account, I guess, huh? All right.
well, that's philosophical. A buck's a buck. And if you can get it out where you can can make use of it, then I would say it's not necessarily an absolute rule. Don't put it in a taxable account. I don't know. I've got some munis in my taxable account, and they too have gone to crazy premiums. They've gone up to the 7-8% premiums in the last year, basically. They've gone crazy. And there's an article, I think it's this week in Barron's, if not last week, about munis are going crazy, and I guess part of it is people are afraid of the Biden's tax proposals coming, and the munis are getting interesting. The only problem, if you want to call it that, with munis in Oregon is 10%, but that's just deal with it kind of thing.
Yeah, there was an article in Schwab, I guess maybe about a month ago, where they compared munis with corporate bonds, and they showed a graph that I thought was interesting that showed that if you're, let's say, in a 25 or 28% bracket, and then you add on top of that the state 9.9 or 9.0 or whatever, that you might be better off from, total cash in your pocket. You might be better off with a corporate bond, that pays like, say, 4 point plus percent. I don't know. But again, these things, these corporate, what do you call them? These guys probably are best in a tax deferred account. Not the munis, of course, but I don't know. I don't know what everybody else thinks about that, but.
Well, the trouble in Oregon with munis is there aren't any Oregon munis in these funds. That's Columbia was the only one that ever had them, and somebody bought Columbia and they don't have anything left. So it's you're just stuck with the fact that you're going to pay 9% or better. I just use the 10 to do it on the top of my head.
Yeah,
it's really not quite 10, but still, you're stuck with it.
Yeah. Okay.
The amount of the adjustment isn't worth the time it takes to put it in your tax return.
Okay, so let's go back here.
Andy, I should mention there are some Oregon municipal bond funds out there. I haven't looked at just how many are left, but there are a few where you can buy them. I think Nuveen still has one. I know the guy who manages that one. So there are some mutual funds where you can play, but they're not Oregon specific bonds, I should say. They have some Oregon bonds in them. And I think there was 1 or 2 that were Oregon specific, but there's not enough supply in Oregon to really keep many funds afloat in that area. It's just, there's just not much volume, which I think is one of Ron's points.
Yeah. I even went out at Schwab to look for Oregon bonds, thinking of buying them directly, and there just aren't enough to make it worth looking.
Yeah, supply is very limited.
Yeah.
I'm sorry, I got frozen out. I'm not sure if you heard much of what I had to say.
Well, go ahead and repeat it then.
Was I able to share my?
Yeah, I'll let go. But hold on here. I'll stop sharing. Okay, there you go.
Was I able to share my screen with the CEFs? Were you able
You
to see
were
that?
you were at first, but then all of a sudden you froze up, Homer.
Oh, okay. Sorry about that. I think the main thing is that there are a lot of anomalies in that CEF space. So let me just go ahead and log in.
So go ahead, while you log in, you might want to show us how you sort for opportunities here.
Okay, register now, log in. So you can use the fund screener.
I can see your CEF screen. Let's put that way.
Yeah, so
Okay.
the fund screener, and then you can just do a new search, and you can search on all sorts of different criteria.
What do you have a recommended set of criteria that you use or that you like, or?
Yeah, I'm trying to find opportunities. So let me get some of the criteria that I've been using. So, you know, a discount is one of them, the amount of discount. So this is the discount. So these are all the ones that have really a high discount.
Hmm.
And then I look at 1, 3, and 5-year return on price. So these have all pretty good returns on price, and yet are selling at a huge discount.
So from an income investor's point of view, would you still use this criteria?
Yeah, I might. If you're interested in income, you know, then you might look at the distribution rate. So
Okay.
HGLB is one that I have also. You know, the distribution rate is 9%. It's relatively small market cap. So the one thing you do have to watch for is liquidity, because some of these are very thinly traded. So if you want to get out of it pretty quickly, sometimes it's a little difficult. But the 1-year return, annualized return on price, so that is one that would be worth looking at. It's at a discount of 21%, but the discount is narrowing. See, this is the discount, this is the price, and this is the net asset value. So over time, the discount has been narrowing. You know, it used to be close to 30%. Now it's 20%. And then you can look at, this doesn't give you that much information. The objective of the fund is to seek long-term growth of capital and future income, the ability to pay dividends in the future. So they do concentrate on the payment of dividends. And this is their distribution. So they're paying on a monthly basis, 7 cents.
So does this show you the holdings that the company that
Yeah, this does. So we can look further down. This is the discount that's narrowing. And this is how they've done. They're a relatively, they've only been around for 2 years. So their returns have been negative 1 year and then very positive the second year. So in 1 year, they've grown 64%. But they don't have more. They don't have more because they're relatively new. And then here are the top holdings. So TerraStar, Vistra, TerraStar. You know, I think these are energy, some kind of energy company. Next Point Real Estate, Argentina. Yeah. So these are kind of unusual. These are high dividend paying holdings.
well, some of them look like they're offshore utilities or something, or what? Or maybe energy companies, I guess.
Yeah.
Yeah.
Here's energy transfer.
Yeah.
Energy transfer. Yeah, I believe TerraStar is doing so. You know, when the solar energy companies are building solar farms, they're selling the solar farms to TerraStar. And TerraStar is generating the energy and paying dividends, paying high dividends. So that's where a lot of their money is coming from. So it's another one of these really odd ones. And then they have bonds as well. So stocks, other bonds, etc.
Do you ever do the bonds or just mostly stock stuff?
Well, these are their holdings. So
Oh, their
47%.
holdings. Oh.
Yeah, they're holding 47%, and then bonds 19%, and other 21%. So, but again, you know, they have a huge discount. They're paying 9% regular distribution, and then the other thing is, you know, if you look at USA, which is down here, and CET, you know, they're not all that much different. So here's USA. It's over the last 5 years, it's been 22% return versus 20%, 19% over 5 years, 58 versus 53. They're both doing very well, but for some reason, this one, CET is selling at a 16% discount and USA is at a 12% premium. So, you know, that seems really sort of
Oh,
odd.
that's, I guess I don't understand why that is, you know,
Yeah, well, it's another one of those anomalies.
interesting.
I'm not sure it's not the quality of the holdings.
Uh,
When you look at what USA holds, everybody can read the list and they understand every one of the stocks.
Okay, so yeah, no, that may be part of it. Let me get to the USA holdings. PayPal, Amazon, Facebook, Adobe, Alphabet. Yeah, so these are all really great holdings.
Tech companies mostly.
Yeah, and then CET, if you go to CET, it's got one of the things that CET does have is an insurance company that is not widely traded. So it's got this thing called Plymouth Rock, which is 23% of its holdings, which is, I think, is privately held. But then it's got Analog, Alphabet, Motorola, you know, Capital One. You know, these are pretty widely.
That's a pretty good group.
Yeah. Yeah.
Can I comment on this, Andy?
Sure. Absolutely. Absolutely. Yeah. Fine.
See, most and Todd, I think you can too, but most of these CEFs are in income categories. Like when you buy them, you're buying funds that basically are buying REITs and utilities and MLPs and BDCs and even CLOs. So what this is what you're talking about with these USA ones and CET is basically just a subcategory of CEFs that are basically equity funds. And the way I look at those is they're just like buying an equity fund outside of a CEF. It's just that what they do to generate their income is basically selling off their gains if they have it. And it's kind of analogous to owning your own shares and just selling them off every year. And they're trying to create an income fund out of doing that. Is that the way you see it, Todd?
Or it is the
Yeah,
capital appreciation.
Yeah, I think they do tend to roll those and you know, play those short-term you know, dividend plays where they can, you know, buy before a big dividend distribution, you know, by the record date and then sell afterwards, sometimes to juice their yields. And so that's part of one of the strategies that I think you're referring to, William, if I understand that correctly. Yeah.
In other words, there a lot of these funds that I've seen in there in this little subcategory of CEFs is that they don't really have any dividends that they're earning. They just create dividends through the management of their capital gains in their fund. That's kind of why I've avoided those, because, you know, I mean, I've looked at it, but I've just so far avoided those. Not sure why, but
Do they show what they buy and sell, William, or you know, in terms of their transactions per month or per quarter or something like that? Do they show that?
I
They
just
do.
see. Go ahead.
They have quarterly reports that they put, annual and quarterly reports to say this is how we did, this is what we bought, this is what we sold.
Okay.
So I mean, in a way, it's kind of like Berkshire Hathaway. It's a holding company that's buying and selling, you know, parts of other companies. Obviously, they're not in general doing as well as Berkshire, but that's kind of the idea, is that they've got this set of money and they're buying and selling, and then they're throwing off the dividends as they go along. Now, the other thing is that there are a lot of these that are like this one, they're holders of municipal securities. So this is a municipal closed-end fund that is paying 4.8%, you know, annually with municipal holdings. So that, you know, that seems pretty good. And it's it's federal tax-free.
So what does what kind of credit, what kind of instruments are these companies owning? I mean, are these loans of some sort or what?
Here, Puerto Rico sales tax, a municipal fund, New York Liberty. Obviously these are not necessarily the highest rated, but they're not bad.
Interesting.
Hey, Homer, pull up NVG.
NVG, yeah, that's
N
another
V,
one.
V
Yeah.
is in Victor, G.
So here it is, the discount has been narrowing and it was up at a premium and then for some reason it's dipped down back to a discount.
So why is the net asset value declining there? Is that because they're selling off a lot of their equity or what? The last few years looks like it's declining.
Yeah, well, it's kind of flat. So we can go since inception. It's been sort of, kind of flat, whereas the price has really fluctuated a lot more than the net asset value.
Mm-hmm.
I don't think it's selling off. It's what it's doing is it's holding these municipals, and it just holds these municipals because it's not getting another cash infusion. It's paying out most of the dividends out to the shareholders of the closed-end fund.
But this is a true income fund versus the USA type funds. So,
Right.
and its income source is munis, and they're basically using this and utilizing 38% leverage to generate these higher yields. It's kind of as simple as that.
Uh-huh.
Right.
Uh-huh. Interesting.
So this one throws in the mid fours. Then there's NUV, which is not leveraged, which is much lower. It's the stable one that Value Line likes.
My question on these is what happens. We alluded to this at the beginning. If short-term rates or whatever their borrowing rate is, which I've never really figured out, if it goes up, these are going to really clamp these funds, I think.
Yep, I would agree.
There's no way you can tell that from the CEF Connect.
Well, the one way you can tell is, number one, is that you can look at long-term, how these have done. So NZ at long-term, over, I don't know how many years this is, September 01. So this is over 20 years. It hasn't gone out. So, different things have happened over the last 20 years. It hasn't affected that much. And then if you look at distributions, you can look at distributions since the inception. So the distributions, I'm not sure where interest rates were, but certainly over the last 20 years, the payouts have continued. They haven't necessarily gone up, but they've kind of continued. Basically,
it looks pretty steady,
Yeah.
Yeah. Huh.
I think you're right, but what we have to factor into this is that rates, the 10-year rate has been falling for over 20 years. And now it is about to rise. So I think the world has changed, and I'm been looking at my own, wondering whether I want to keep going as I have been going.
Right. Who knows? Yeah. Who knows? Maybe.
Yeah, I think William raises a good point here. If rates start to rise, these guys may get squeezed. Yeah. Okay. We have about 10 more minutes before we should switch over to talk about the group. Does anybody have another stock they want to
Yes,
talk about?
I do.
Okay, sure.
FE and Starbucks.
Okay, let me hold on here. Let me share my screen again, and I'll bring up fast graphs here. And okay, what's this? Which one? Starbucks? You want to go Starbucks first, or?
Sure, does not matter.
Well, what's the ticker symbol for that one, Siri?
SBUX.
Okay.
No, SBUX.
SBUX. Okay. Hold on. Oops, I did something screwed up here. I don't know, my fast SBUX. Oops, that's not right. Oh, there it is. Okay, all right.
They just increased the dividend payout, dividend yield.
Okay. Well, the thing that jumps out at me, you know, being the
More
conservative guy that I am, is the blended earnings yield is only set 2.9. That doesn't excite me at all. I mean, and the dividend yield, you know, to me is low. I don't. Anybody else have a comment on this one? This looks like a nice, maybe a growth stock in that sense.
Okay.
Not so much a dividend stock. Well, what's the big dip here in earnings, Siri? Do you know?
COVID.
COVID, yeah.
Okay.
Let's move on to FE. Frank
pardon?
Edward.
I'm
Frank
sorry.
FE. Frank Edward.
First Energy.
First Energy. Oh, okay, there we
Yep.
go. So this is a utility, is it?
Yes.
Yeah.
Okay. Well, it's paying a nice dividend. Dividend looks fairly flat to me. And looks like the nominal price to earnings ratio has declined, but it seems to follow, the price seems to follow that fairly closely with, you know, return to the mean, so to speak. Anybody else have a comment on this one? This looks like a utility of some sort. Yeah, electric utility.
Yeah. Value Line loves it.
Value Line loves it, huh?
Yeah.
And what's they give it a high rating, Ron?
Yeah. It's a 1, I believe.
What are the total returns? Can you pull up that graph, Andy?
Okay.
Because the dividend yield's okay, the growth is dismal,
Yeah,
or it's zero.
yeah, you can see that you know, $10,000 here, you know, invested would give you a dividend yield of 11,000 versus the S&P, which is 4,600 something, and then down here, the total return with dividends and growth are not quite as good as the S&P.
But again, look at the last 4 or 5 years.
Okay. Let's go 5. Let's go 6 years just to see what it tells us. How come this thing is only doing 3 years? Jesus. Well, let's go one more. Let's see. Oh, that's about 5 right there. Well, I don't know, Tom. What do you think? It's looks
Well,
like to me.
I see 3 zeros, and then it looks like it's recovering. But I also look at the look at it versus the S&P, and it looks like it's, what is ROR, return on?
Investment.
It's return on investment, basically.
Okay,
Yeah.
so I look at it, you know, 2.3% versus 14.9 for the S&P. I think you can get that 4.3% yield with something that gives a much higher total return.
Yeah, yeah. Well, still, this is a what do you call it? A utility, right?
Utility.
Yeah.
It's a regulated utility.
It's a what?
Regulated utility.
Okay. So its sales are fairly flat, which is shows here. So how are they? And they're not increasing the dividend much. So yeah, okay, that makes sense. All right, okay. So I don't think this particular one you would see a lot of growth in dividend, although the dividend yield is very nice. It's 4.3%. But the expectation would be that you would not see a lot of growth in dividend in this particular utility. Let's see what the analyst group is. Pretty good record, pretty good support, pretty good performance. And let's see here. If I go to the forecasting models and I just use 15 times earnings, and I just do that and go out here to, well, 8.29%. This is a qualified dividend, isn't it, Tom?
Should be.
Should be.
Yeah, I think so.
Yeah.
But I look at so many of these just to say, not is it good, but can I do better?
Yeah.
Well, it's not an electrical utility, but the TELUS, TU is a Canadian telephone company.
Mm-hmm.
And it just, in terms of dividend, I think is very, very similar, yet in terms of total growth and dividend growth is much better.
Yeah.
Yeah, looks like it.
Hey, Andy, don't you get the utility newsletter, right?
I do, yeah. Mm-hmm.
Well, he's pushing TELUS all over the place.
Is he really?
Yeah.
I haven't looked at the latest one. He ranks, let's see, well, he has, the two which portfolio do you follow around? Is it the growth one or the income one?
Neither of them, individually.
Okay. The growth one, he's got ranked number one, looks like NFIG or something like that, NRG, let's see.
NRG, I think it is.
NRG, all
Yeah,
right,
yeah.
Let's look at that. See what that's, I haven't looked at it lately, so.
Personally, I've had first, FE and some of those for years. I have them in my IRA with the intent of just trying to get the RMD thrown by dividends, which I've done pretty well with. So it's been stable rather than looking for necessarily growth, since the growth of the RMD is because of age, not because of the stocks that are in it. So I've had a lot of these for a long time, and they're just stable. I guess it's a question of what you're looking for. Do you want a stable 4%, or do you want 6% that's maybe not so stable?
Well, this guy here looks like it's paying 3.14 right now, and its earnings yield is pretty good, 14%. That's pretty high. Looks like they've had a huge jump in earnings here the last couple of years. Yeah, does anybody know what that's caused by, or what caused them to have a huge jump?
No.
BBB plus, I guess that's above investment. Is that below investment grade or above? I don't remember now. Yeah,
It's above.
above.
I think triple B is the bottom, isn't it?
I think it's triple B minus, or is it
Just triple B.
triple B? Okay.
They may have made an acquisition. I'm trying to remember. I looked at this years ago, but I don't remember right offhand. I seem to remember there may have been some large acquisition that caused their numbers to be skewed.
Let's see what their sales look like. Well, it looks like they had a big bump in sales here and here, and then it dropped way down. So that must have been the acquisition, Todd, do you think? Must have been something there. Or I don't know.
That's what I'm thinking. It's sketchy. I'm certainly willing to take a look at it. I know it's a company that's been highly recommended by various services.
Yep.
Yeah, looks like this utility. I'd subscribe to this utility forecaster. And he's recommending it in his growth portfolio as number one. I haven't read the latest version of this thing, so I don't know details. I suppose I could put it out there when we adjourn here, and I could send it to everybody. Well, we're getting past 3 o'clock here. Siri, did we answer all your concerns or questions or anything?
Yes, I'm not a dividend investor, but I was just looking at some of the information,
Okay.
trying to see with the market being so high, I wanted to put some money into the dividend producing stocks for safety reason.
Mhm. Well, the ones that I'm looking at right now, just to pass along suggestions, is some of the pharmaceutical companies looked good to me, like Bristol Myers Squibb. Let me use BMY. Yeah. And they just took a hit on Friday because for lack of a, yeah, see, look at here. If you look at them, the analyst community is forecasting huge growth that looks promising, and the price of the stock has not done much. And the nominal price to earnings ratio is looking strong too. So to me, this looks like an undervalued stock. It's paying a 3.5% dividend, good earnings yield. It's A+ rated. This is interesting. So, and their dividend growth rate, it's not been spectacular, to be perfectly honest. Looks like the compounded annual growth rate was 2.9% for the past 20 years. If you chop off everything from 2006 earlier, let's do that. You get a little better yield on it. But so, you know, from a dividend point of view, it certainly is a little better than, you know, it's better, I guess. It's better than the S&P 500, but from a growth point of view, not so good. 7.2% versus 13. And then if we combine the two, the ROR is 9.7. So this is definitely an income-oriented kind of vehicle, not a capital gains kind of thing. I also took a position in Merck, I guess, M-A-R-K.
Merck, yeah.
Yeah. Do you guys, any of you guys have that?
Yeah, I've got Merck. I've had it for a long time. I'm just holding on to it. That's it.
I bought some recently, also just a small amount.
Yeah. Wow. Look at this. This is.
Well, they've had this COVID drug that was announced, and it has some controversy, but it has some high potential as a COVID cure. So I think that's what lit the stock on fire here recently.
Mm-hmm.
That was that pill.
Yeah, the pill, I think.
That's to reduce the risk of once somebody's contracted COVID, right? Is that what that was?
Knocked it down 50%.
Yeah. Okay.
The other thing in all of these drug stocks is the argument over the pipeline, because there's with BMY, there's a big argument over whether their pipeline overshadows the fact that they're losing their big money maker.
Well, yeah, you're right. There was a press release on
whatever your machine uses. I use one that I bought years ago. It's not Adobe, and just pull it up and then just print it to your hard drive as a PDF.
Yeah. Sounds simple enough. Good.
I'm going to put you guys down for For next week, I mean, for next month.
Yeah, I think it's a great idea. Let these guys can collaborate on Value Line. We've got several people and
Okay.
share the online version.
I'll get in touch with Ron and Rich and we'll work something out here.
I've been able to log in from home and check on any of the stocks that I want to take a look at it in Value Line and Morningstar.
Yeah,
I
that's
don't have to go
nice.
to the
isn't it?
library.
Yeah. Any other comments before we wrap up here?
Just a thanks to you, Andy, for, both today and the years of doing this, and hopefully many more years of doing this.
Well, I'm getting old at this. I'll tell you what. I won't go away. We went to a funeral last weekend, and God, just yeah.
It happens.
That's a long story, but I won't bore you with that. Coming back on the plane, I sat next to a guy who refused to wear a mask.
Oh man.
Yeah, so well, that's another story, but yeah, he sat between me and my wife, and so
I'm surprised the airline didn't make him do it, but
well, they did, but he took it off, so, and they didn't follow through. So that's another story. Yeah. Okay, let me get back and share my screen for just a second here and finish up here, I guess. Well, our next meeting will be, well, let's go here and then go here and go here. Yeah, our next meeting will be September the 7th. That's the first Sunday in November the 7th, excuse me. In November. As I say, keep sending me your ideas and suggestions for topics or speakers. We'll do something on Value Line next month. Ron, when and if the tax stuff gets settled down, maybe we could get you to do something on that, huh? Maybe kind of a summary on that. Maybe next year sometime.
We'll see what's happening. Yeah, it's all up in the air, as you know, right now.
Yeah. Okay.
By the way, there is something that has been out there. It's not been a secret, but I think maybe people haven't locked onto. For this year only, the amount of charitable contribution is unlimited.
Oh,
unlimited.
So think about it.
so
I'm about to make use of it, and when and if I do, I will explain to you what I have done. But normally, you see, you got a 30% cutoff. As soon as you exceed 30% of your AGI, you have to carry it forward. You don't lose it, but you have to carry it forward. For this year, it is unlimited.
So if you're thinking about making contribution, you might do it this year rather than next year because of the unlimited amount, if it's going to be sizable anyway.
If it's going to be sizable, yeah.
Okay.
If that's for charitable contributions. What
Correct.
about gifting? I like to give my grandkids some
Nope.
college stuff.
Nope.
College. Nope.
Nope.
Sorry. Oh well. So much for that.
Nice try, but no.
Yeah.
Another quick question on that. Are donor advised funds
No.
acceptable? Nah.
Nope.
Had to
Nope.
try.
It's out the door money.
Yeah. Okay.
Oh well. All right. Yeah. Hey, Congress. Yeah. Right.
Yeah. Grab it while you can.
Right.
They're closing those loopholes and everything else as quick as they can.
Okay. So by all means, here's my email address, and you feel free to post to the group. We love to have commentary there, and I appreciate anybody who posts stuff there. That's really very, very valuable information. And so our next meeting will be November the 7th.